It is 11:47 p.m. on a Tuesday, and you're lying in bed scrolling through your bank statement because you can't sleep. You make good money. You know you make good money, but the account balance doesn't reflect it, and you can't figure out why. So you start scrolling backward. Netflix, $15.99. Spotify, $11.99. That meal kit you tried twice and forgot to cancel, $69.99 a month for 4 months. The cloud storage plan you upgraded to because your phone kept buzzing at you, $2.99. The gym app you haven't opened since March, $19.99. Peloton, Audible at Cloud. Amazon Prime, a dating app you don't even use anymore because you're married. You keep scrolling and the number keeps climbing, and by the time you reach the top of the statement, you've counted 14 separate charges, none of them bigger than $20. All of them added up to $412 a month. You didn't buy a car. You didn't take a vacation. You didn't do anything you'd remember in 6 months. You just quietly wired $4,944 this year to companies you forgot you were paying, one invisible sip at a time. This is the subscription trap. It is not a single bad decision. It is 1,000 tiny ones, engineered by the smartest behavioral scientists in Silicon Valley to be too small to notice and too annoying to cancel. And over a working lifetime, it will cost you more than your car, more than your wedding, and in some cases more than your house. My name is Lona, and I spend way too much time reverse engineering the tiny financial leaks that are bleeding disciplined, high-earning people dry. If you have ever opened your banking app and felt a flash of dread scrolling past charges you don't recognize, or if you have a running list in your head of subscriptions I should probably cancel that never actually gets acted on, hit that subscribe button and give this video a thumbs up, because today we are going to perform an autopsy on the $9.99 economy. We are going to look at the psychology of drip pricing, the compounding math of recurring debt, and why the businesses you trust the most are the ones quietly running the most sophisticated extraction machine in the history of commerce. Here's the thing about subscriptions. They were never designed to be evaluated. 50,000 Australian dollars car purchase gets scrutinized. You research it. You negotiate. You feel the weight of the decision. 9 Australian dollars and 99 cents charge is designed to slide underneath your brain's risk detector entirely. Behavioral economists call this unit bias. Our brains evaluate a purchase based on how big the individual transaction feels, not on its actual lifetime cost. $10 feels like nothing. It feels like a coffee. It feels like a rounding error. So you say yes without a second thought, and the company is counting on exactly that reaction, because they are not selling you a product. They are selling you a habit of not looking. Let's run the actual math, because the math is where this stops being annoying and starts being terrifying. The average American now carries somewhere between 9 and 12 active subscriptions. Let's be conservative and say you're disciplined, so you only have 8, averaging $14 a month each. That's $112 a month, or $1,344 a year. Now ask yourself the same question we ask about the mortgage or the car payment. Would you voluntarily sign a contract committing $1,344 a year to a bundle of services you barely use? No. You would say that's insane, but you already signed it. You just signed it 14 separate times instead of once, which is exactly why you never felt the weight of it. Now let's do the opportunity cost simulation, because this is where the real damage lies. Let's say you're 28 years old, and instead of bleeding that $112 a month into subscriptions you don't use, you audited your accounts, kept the 2 or 3 you actually value, canceled the rest, and invested the difference, call it $90 a month, into a low-cost S&P 500 index fund. You do this every month from age 28 to age 65, at a historical 8% average return. That ignored $90 a month becomes roughly $310,000 by retirement. Let that sink in. Not because subscriptions themselves are evil, but because the ones you forgot about, the ones providing zero value, are quietly amputating $250,000 from your future for a meal kit you used twice. This is where we need to redefine what a subscription actually is, because the industry has spent a decade rebranding it. They don't call it debt. They call it membership. They call it access. But strip away the language and a subscription is a recurring, automatically renewing financial obligation that exists specifically to remove your moment of choice. A normal purchase requires you to say yes today. A subscription requires you to say no, actively, on a specific date, through a specific portal, that is very often deliberately buried, 3 menus deep. This is called the cancellation friction gap, and it is not an accident. Companies A, B test their cancellation flows the same way they test their checkout flows, except the goal is inverted. The checkout flow is optimized to make saying yes effortless. The cancellation flow is optimized to make saying no exhausting. You have to find the settings page, then the billing page, then click cancel, then sit through a retention offer, then confirm you really mean it, then sometimes call an actual phone number and wait on hold. Compare that to the 3 seconds it took you to sign up on your phone at a red light. That asymmetry is the entire business model. Now, you might be thinking, Lona, it's $10. I'm not going to ruin my life over Spotify. And you're right. One subscription won't ruin you. But nobody has one subscription anymore. The average household in 2025 is paying for 4 or 5 streaming services alone, believing at every step that they've made an isolated $10 decision, when in reality they've built an entire second rent payment out of fragments too small to individually justify canceling. This is death by 1,000 cuts, and it works precisely because each cut is too small to bleed you out in a single moment. You don't feel $412 a month leave your account. You feel $15.99 leave 14 separate times. And your brain files each one under, basically free. There's a deeper psychological trap buried in here too, and it's the sunk cost version of subscription guilt. You know you don't use the gym app, but you paid for the annual plan back in January, so canceling now feels like wasting the money you already spent. So you keep paying monthly to avoid admitting the January decision was wrong. This is completely irrational. The money from January is already gone whether you cancel today or not. But subscription companies understand this psychology intimately, which is why annual plans and lock in this rate messaging exist. They're not selling you a discount. They're selling you a sunk cost that will keep you paying for years after you've stopped caring. Let's talk about the version of this that hits high earners specifically, because this is where it gets genuinely dangerous. The more money you make, the more subscriptions you accumulate, because subscriptions are marketed as tiny upgrades to a life that's already going well. You don't need the premium cloud tier, but you're doing fine financially, so you upgrade anyway. You don't need 3 different streaming platforms, but $10 feels irrelevant against a 6-figure income, so you stack them without resistance. This is the same lifestyle creep we've talked about before, except it's invisible lifestyle creep, because a $1,000 monthly car payment shows up on your radar, while $600 spread across 19 different microcharges never triggers the same alarm. High earners aren't worse at discipline, they're worse at noticing, because the dollar amounts are calibrated specifically to slip beneath their income-adjusted attention threshold. So how do we fix this, without becoming the person who cancels Netflix and calls it a financial strategy? First, you have to make the invisible visible. Pull 12 months of bank and credit card statements, and manually list every single recurring charge on one page. Not an app, not a summary, an actual manual list, because the act of writing it out forces your brain to confront the total in a way that scrolling never does. Second, apply a brutal test to each line. Have I used this in the last 30 days? And would I sign up for this again today, at this exact price if it didn't already exist? If the answer to either is no, it gets canceled today, not next month, not after the free trial ends, today. Third, take whatever monthly total you just freed up and immediately redirect it into an automatic investment transfer the same day, so the money never touches your checking account long enough to be reabsorbed into some other convenience purchase. And finally, put a recurring calendar reminder every 90 days to run this audit again, because subscription companies are relentless about adding new charges, and your only defense is being equally relentless about reviewing them. The uncomfortable truth is that the subscription economy isn't broken. It's working exactly as designed. Every product manager at every one of these companies is optimizing for the same metric, reducing your friction to say yes, and increasing your friction to say no. You are not failing at willpower. You are losing a psychological arms race against teams of engineers whose entire job is to make sure you never look too closely at the total. The only winning move is to look anyway. A subscription is not a bill. A bill is honest. A bill tells you exactly what it costs and asks you to pay it once. A subscription is a permanent, silent claim on your future income that renews itself in the dark, hoping you never turn the light on. Turn the light on. Run the audit tonight, because that $9.99 isn't $10. It's a piece of your retirement, leaving quietly, 1 month at a time, for the rest of your life, unless you go looking for it first. If this video made you open your banking app right now, share it with a friend who still doesn't know what they're paying for. Save them $300,000. Thanks for watching, and I'll see you in the next one.